of keen interest in the fixed income space with a lot of volatility and uncertainty. So we're very happy to have a panel of amazing experts from the fixed income space, from some of the leading global fund managers who are very important partners of Endowus. So today I'm joined by my colleague Yulin. We seem to be doing a lot of webinars together recently, so bear with us, but we won't be the only ones talking. We'll be talking very little today, in fact. We have Arnold from AllianceBernstein, we have Giselle from Fidelity, we have Alan from Neuberger Berman, and Gordon joining us from PIMCO, four amazing experts in the fixed income space. Next week, we're going to be having a follow-up session, reminding everybody that this is a series of webinars we are hosting with our FMC partners, fund manager partners, in celebration, but also coinciding with the launch of the Endowus income portfolios. Today is going to be focusing on the fixed income asset class, and next week we'll be focusing on the equities asset class. So again, Yulin and I will be there, but we'll be moderating. We have some great speakers next week joining us as well. So please join us next week as well for the webinar. We need to get a few disclaimers out, and since we have 5 companies here present, we have to show all 5 disclaimers for each of the company. So disclosures and disclaimers galore. We also have our usual Slido poll questionnaire. So please go to Slido, punch in this number so that you can leave your questions, and we'll do Q&A session at the end as per normal. If you're on YouTube or any of the Facebook or LinkedIn channels, then there's information below with the Slido as well in the middle of the session if you need to. And for those that are less familiar with Endowus, very briefly, Endowus is a digital fee-only wealth platform. It's the first and only digital advisor for CPF. As a result, it's the only digital platform where you can manage all of your wealth, your CPF, your cash savings, and your SRS, backed by some of the leading global strategic and venture partners. We just introduced the new Endowus income portfolios. So apart from the core strategies that we have for flagship and ESG sustainable portfolios, and the various satellite portfolios that we have also an income portfolio now. And we'll go into a little bit of detail why income investing is important. It's very popular here in Singapore and also in Hong Kong, across Asia. It really is to use income portfolios to supplement your regular cash flow, or to seek shelter on rainy days with a lot of volatility and distress in markets. And also really to strengthen the portfolio through diversification, through income assets, which are generally a little bit more higher quality with low correlation to other asset classes. We really listened to our clients before we even designed and built this portfolio. So these are some of the key features that our clients and our customers and potential customers told us must be in the income portfolio. So preserving the invested principal. So many income portfolios or annuities draw down from the initial invested capital, and a lot of people don't like that, or they don't even know that's happening. So you're effectively putting your own money and then drawing from your own money instead of building wealth and preserving capital. But also they were really sensitive to fees, because we know that a lot of products out there have very high fees embedded in them. And then the targeting of the yield or capital appreciation and then flexibility, because a lot of these insurance products, especially in annuities, have long lockup periods. And so that's why we built the Endowus income portfolios. And Yulin will go into some details about the portfolios.
Yeah, thanks, Sam, for that background. So with the survey results in mind, we launched our income portfolios last month, and it's a really unique offerings on the market. So firstly, it really offers flexibility based on the needs that we have understood from listening to all of you. Whether you want stable payout or higher payout, or capital preservation, or actually a little bit of capital growth, there is a portfolio that suits your preferences. And the portfolios are also built using the all-weather approach. So they're all globally diversified and they're optimized to only take calibrated risks across market cycles to offer both resilience and to target the different investment objectives that they are set out to achieve. And thirdly, the portfolios are, we built them using the multi-manager approach. So to make that possible, we partnered up with top tier professional global fund managers, some of which are here with us today, to offer you some of the best income generating funds around the world. And as if you're familiar with Endowus, you will know, we are constantly advocating for lower and fairer fees. And this is consistent with income portfolio as well. So we offer institutional share classes, or we offer 100% trailer fee rebates on all of the funds that we offer within this portfolio. And as Sam mentioned, there is no lockup on these portfolios at all. There's daily liquidity, and you can invest any amount at any time with no lockups at all. So let me go into more details of the 3 different portfolios that we have launched, tailored for different needs, for different life stages. And the first portfolio is stable income. It will be great for those nearing retirement, planning for retirement, or having already retired. And it focuses on generating a stable and consistent monthly income stream to supplement one's retirement income. So the current payout target for this portfolio is 4 to 5%. And at this stage of life, you would have already saved up a decent amount of money for retirement, and the need for capital preservation is pretty high. So this portfolio targets preserving the investment amount over the long term while paying investors the monthly income. And it achieves this by investing in high quality and diversified income funds. But of course, if you are looking for something else, there is a second portfolio, which is more for, what Singaporeans call the sandwich generation. So, working adults who have higher living expenses because they have their parents as well as their kids to support. They have some savings, but they need to balance between the heavy and regular expenditures for families, such as, paying down the mortgage, as well as trying to save up for the future. But they're also able to take on risks as, the time is still on their side. They have a longer time horizon. So this targets 5 to 6% current annual payout, as well as a moderate level of capital growth. And to achieve this, its asset allocation is 80% in higher yielding fixed income sectors and 20% in dividend-focused equity funds for capital growth. And lastly, we have future income, and we designed this with young working adults in mind. Therefore, the portfolio has a dual objective of paying a reasonable amount of income, as well as providing a higher capital growth over time. So the income part, it might not be able to cover all of the expenses, but it will still supplement your monthly needs, such as caring for a pet or paying for a hobby, etc. And to achieve this dual objective, we allocate 60% to high quality fixed income and 40% to equities. So when it comes to choosing between the portfolios, it is important for all of us to understand our needs, as well as the trade-off between risk and return. And here is just a snippet of the comparison in terms of estimated total return and the risk metrics for each portfolio. And as you can see, stable income has the lowest risk among the 3, and future income and higher income, because of their targets of higher income and higher capital growth, they're riskier. But this is just a snippet, and for more detailed comparison, you can go to our website's insights page and have a look at the deep dive article. We are fully committed to be as transparent as we can to serve you in making informed investment decisions. Over to you, Sam.
Yep, and it's great to have 4 of our amazing partners who have built this product with us. And the last point I want to make is that on the Endowus platform, we always try to achieve the lowest cost possible in the industry. So as Julian highlighted, removing trailer fees, accessing institutional funds, and negotiating special deals allows us to build portfolios and give you access to funds which are the lowest in the industry. With that, I think we're going to go jump into each individual fund manager, and we'll start with a brief introduction of the speaker and then an introduction of the company and their fixed income investment capabilities. So we're going to start with AllianceBernstein first. Arnold, you're up.
Hi, Sam, and thank you very much for inviting me to speak today. My name is Arnaud Mounier. I'm head of the fixed income business development effort in the APAC region, and been with AB for almost 7 years. So today I'll just give you a brief overview of our firm and our fixed income expertise. I think you were talking about your income product, Sam. We've been managing income strategies at AB for a very long time. Some of our flagship strategies have about or over 25 years of track record. So there is a real expertise in terms of managing income strategies in our fixed income team. And some of the portfolio managers that have been there at AB all this time are still managing some of these strategies. And so you can see that the years of experience of our portfolio manager, traders, and research team is very experienced and very high. But I think what's important is the DNA and the experience of managing those portfolio across cycle is still with us. The second thing the second point I would like to leave with you with is all the investment we have made in technology over the last 5 to 6 years in our fixed income team. We have over 100%. Over 100 people that are dedicated to technology and enhancing our fixed income process. It's a large number because we are using those technology specialists to, for instance, data cleaning, data crunching, but also digitizing all our research outputs, whether it's fundamental research or quant research, but also developing tools like our trading tool is an internal tool that we have developed. Our credit scoring tool is also a tool that we have internally developed. And more recently, we have developed what we call a virtual portfolio assistant that we call ABI, which is really there to automatize a number of tasks from, let's say, dispatching the trades across the different portfolios, making sure that we are respecting all the guidelines and constraints in the portfolios. And this technology is really important for let's say our portfolio managers to spend less time on mundane tasks, but to spend more time on the real market controversies. The third point I would like to mention is how we have been integrating ESG across all our fixed income strategies. It's not just a few fixed income strategies that have ESG focus. Across all our fixed income strategies, when we talk about integration, it means that we have ESG scores not just for corporate bonds, but as well for sovereign bonds and for securitized assets. So when we have an income portfolio, we are using ESG scoring, internal methodology based, to determine how these ESG scores are influencing our credit assessment of the issuers we put in our portfolio. So those are the key 3 points: the people, the technology, and the ESG integration. Since 2004, we have been combining fixed income, let's say, quant research and fundamental research in our fixed income investing. So it's not something new. When quant has become a bit more trendy recently for some of our competitors, I mean, for us, it's been there for a long time. And the reason is when you do an income strategy, you're potentially tapping a fixed income market with over 70,000 fixed income securities. And when you want to assess such a large universe, you need to be able to look at quant data to really understand what is rich, where there is momentum, what is expensive, what is cheap. And quant is very useful for that. But there are a number of situations where quant is not necessarily a good guide. And you have a few recent examples where, for instance, when central banks were through their quantitative easing program, even though all interest rates were screening pretty expensive, you need the fundamental research and understanding to see that maybe those interest rates would stay low for a while. So we are really combining both in all our fixed income strategies across the board. And the final point I want to make about AB, and that's on the first slide, is our global presence. And you can see we have 3 main portfolio management, let's say, location for fixed income: New York, London, and Hong Kong. But we have, let's say, expertise in other locations. And so a really truly global reach for our fixed income team. And I'll stop there, Sam.
Great, thank you, Arnaud. I'm going to hand over to Giselle and Fidelity.
Thank you, Sam. Hi, everyone, and good evening. This is Giselle from Fidelity, and thanks for having me today. I'm the Associate Investment Director from the Asian Fixed Income team, and I cover Asian Fixed Income related strategies from stability focus to income-driven solution. As a brief introduction of Fidelity, what truly differentiates us as an active manager is that the fact that we are privately owned. So that allows us to really focus and stay independent for client solutions. We manage over 800 billion in assets globally. And the bread and butter of Fidelity is really about our global investment capability and research team with over 400 investment professionals across the group. In the next slide, specifically for Fidelity Fixed Income, we manage over 100 billion of assets. And we manage a strategy with different orientation. So you can see in global aggregate, investment grades, high yields, EM to money market funds with over 20 years of experience for various set of clients globally. In particular, we are very proud of our Asian fixed income capabilities. We are one of the pioneers establishing Asian fixed income team in 2002, and we manage over 25 billion of assets dedicating to Asian fixed income strategies today. In the next slides, you will see that of the full suite of solutions we offer to our clients across different risk and return spectrum. On the upper right, that comes with high return and high volatility. There are options in China high yield, Asian high yield, and Asia Pacific blend. For investors who want more stability, they may consider strategies focused on emerging market debts, Asia investment grades, China bonds, and ultra short duration bond funds as well. That's a brief introduction of Fidelity, and I look forward to sharing our insights to you around our Asian and China fixed income perspective later. Back to you, Sam.
Thank you, Giselle. Over to you, Alan and Neuberger Berman.
Thank you, Sam. Thank you for the invitation. I'm Alan Yip, the Head of Portfolio Solutions for Asia Pacific. A bit about Neuberger first. Neuberger is an employee-owned international asset manager with a strong presence in Asia. We have over 80 years of history, and we have a full range of investment capabilities from traditional asset to alternative assets. Now, of the total AUM of over 400 billion, over 40% are invested via our globally integrated fixed income platform. If you go to the following page, you see that we have a range of fixed income capabilities from US to emerging market, from public to private debt, and we have offices throughout the globe, and we have clientele by different types and also from different geographies. And if you please go to the next page. Now, when it comes to EMD, which is my topic for today, we have a very strong EMD team, which has been working together for over 20 years. Now, our emerging market debt team, they adopt a research-driven, bottom-up, and disciplined approach to investing. The team has been ahead of the curve in terms of developing its EMD experience from hard currency, local currency, to EM corporate bonds, and then also dedicated onshore China bond, for example. If you can please go to the next page. Now, you see that now the emerging market debt team have a full spectrum of emerging market debt under management, from high currency to local currency, sovereign to corporate, global, regional, and also single country emerging market bond.
Great.
Thanks. Yeah.
Thank you, Alan. Last but not least, Gordon from PIMCO.
Great, thanks very much, Sam, and good evening again, everybody. And thank you to Endowus as well very much for inviting me here to be a part of the discussion today. My name's Gordon Harding. I'm a product strategist at PIMCO based in London, and I cover what we call flexible strategies. So these are the strategies that are able to invest across a variety of sectors within the fixed income market. I'll be quite brief on the introduction to PIMCO, but I think the key point to make is that we are one of the largest bond investors globally. We manage altogether more than $2 trillion And as you might expect from one of the largest asset managers, we have significant resources and expertise across all of the fixed income market areas. Although originally actually a West Coast of the US asset manager, we're also actually a very, very global organization. As you can see here, we have offices with investors based across the US, Europe, and in Asia Pacific as well. And if we go on to the next slide, here I'll be very brief. I mean, we do have real strength and depth in our internal resources, and we have what we would term a fully integrated investment platform with ongoing communication across all of our teams globally, so that the experts that we have across the globe are all encouraged to participate in the investment process, continually feeding ideas from their areas of expertise into our portfolio managers across the globe. And that's really important for all of our strategies, but also particularly our income strategies, which are able to invest across all of the different fixed income sectors globally. And then next, of course, as I mentioned, we have a huge amount of internal expertise, but what I think is really interesting is that we also regularly invite experts from outside of the company, from different fields, to join our discussions on the economy and on markets, to provide challenge to our own views and to help us avoid groupthink. And something that I think really sets us apart here is that we set up what we call our PIMCO Global Advisory Board. This is made up of world-renowned policymakers and macro experts, chaired, as you can see here, by none other than Ben Bernanke. This is a board that meets several times a year, and they join our discussions and give us really unparalleled insights into areas like monetary policy or politics, and really help to inform our overall investment process and challenge our views on markets, as I mentioned before. So I'll leave it there and hand it back to you, Sam.
Great. Thank you so much, Gordon, and everybody. It's always fascinating to learn about the history and capabilities of the fund managers. We're going to delve right into the meat of the discussion now. Obviously, we are in an environment that is not normal for fixed income. We are embarking on a tightening cycle where global central banks are embarking on, interest rate hikes, or in the case of the Fed, reducing their balance sheet as well. And there's a lot of uncertainty and volatility in the markets as well. So I think it'd be really good for us to maybe set the tone by reviewing the overall fixed income market from a global perspective. And we'll start in reverse order with Gordon from PIMCO.
Great, thanks again, Sam. And I would agree with you there, without being too or sounding too alarmist there. We think there is quite a degree of uncertainty around the outlook this year. The past couple of years have seen quite a strong recovery from the COVID shock, and the growth has been supported by a huge amount of central bank and fiscal stimulus. And this has also supported markets as well. And generally, they've done very well as a result of that. But we are moving into a period now where that support is gradually being withdrawn. The economy is really transitioning from that sort of stimulus-led growth to a more organic growth, which might leave it potentially more vulnerable to outside shocks. But overall, when we look at the growth picture for this year, we do see positive and above trend growth in the major economies. A bit slower than we've seen in the recent past, but nonetheless, as the global economy continues to recover, we think we're likely to see positive growth. A big discussion at the moment, of course, is on the inflation side of things. And this is likely to continue to be a challenge, certainly in the near term, because we're seeing some pretty significant inflationary pressures as the economy is opening up. We saw headline inflation in the US for December hitting 7%, which is the highest since the early 80s. And that number might even be higher than that when we get the next reading tomorrow. And this is why central banks have become more hawkish over the past, let's say 3 or 4 months or so, and have been signaling a much faster pace of rate hikes than previously was expected. So we actually think that inflation is likely to trend lower over the second half of this year, but we are still seeing a significant amount of demand for goods and services, which is likely to stay quite firm as economies do open. And we're also, on top of that, in the middle of some pretty significant supply bottlenecks that are also pushing up on inflation right now. So there is still some uncertainty there, even if we do think that in a base case that inflation is likely to reduce over the second half of this year. So that base case is for above trend growth and moderating inflation and a gradual tightening of monetary conditions as well as central banks raise rates. But if you move to the next slide, you'll see just a few of the key things that we're looking at from a macro perspective that do have the potential to impact markets this year. Firstly, of course, there are still challenges with respect to the virus as we're seeing cases increase as a result of Omicron at the moment, even if it is a milder variant. And there continues to be the risk of newer variants emerging that could cause some damage, of course, from a health perspective, but also could be disruptive to the ongoing economic recovery. As I mentioned already, inflation currently is very, very high, and we do think it will reduce, but over the second part of this year. But there is also the risk that it does remain elevated if inflation expectations become embedded, and there is a chance that we see inflation remain higher for a longer period of time, or simply if those supply bottlenecks don't ease over time as well. And third risk, I would say, is on the central bank side of things. The Fed, again, of course, has become much more hawkish in recent months, and now the market is pricing in around 5 rate hikes or so in the US this year, which is quite a significant amount. But if inflation does stay higher for longer, we might even see a potentially more aggressive response from the Fed and other central banks as well. So altogether, as you mentioned, Sam, we might see greater volatility this year than we have seen in the recent past. So, this is an environment of uncertainty on the healthcare side, uncertainty in the near term on inflation, and uncertainty with how policymakers are going to respond to that. So at this point in time, and we'll talk about this as we go through, we think it is certainly an advantage to have a flexible strategy or portfolios that have flexibility to manage these key risks. And I would say particularly around something like duration or interest rate risk. Back to you, Sam.
Great. I think those are the two key risks that are out there, right, in terms of credit and interest rate risk in the form of duration. So I think it's perfect segue into Arnaud to address those risks in the market.
Sure. Thanks, Sam. And I think, we would agree with Gordon on the path for interest rates. Actually, our view for the Fed rate hike are maybe slightly more conservative than the market. We're probably thinking 3 to 4 rate hike for this year. But what's important is, as Gordon highlighted, there is volatility probably on the way now that central banks are removing their quantitative easing and letting the market, live their life a bit more independently. And so I think it's everybody's guess what's going to be the number of rate hikes. It's just going to be a more volatile environment, and that's probably the only thing that we know for sure. When it comes to the US 10-year, internally we are forecasting the 10-year to finish 2022 anywhere between 1.75 to 2.25% in terms of yield. So we are actually already there in terms of range. We are close to 2%. So we don't really see a massive increase in the 10-year. What we are seeing more is probably a flattening of the yield curve. And so the question that people are asking us is, if interest rates are going to increase, even modestly, why should you invest into fixed income? And more specifically, why should you invest into duration? The question, or let's say the answer, is a bit also in your surveys. And when people are investing in an income solution, I think the first answer to your survey was they want also stability of NAV, stability of principal. And I think you cannot get this stability in an income solution without taking some duration. And I think the duration in your portfolio to balance the credit risk you need to take to generate enough income is really important. If we go to the next slide, Sam, what we are doing is we are plotting for the last 22 years, the time when treasuries have been performing negatively versus the time when high yield have been performing positively, for instance, and treasury being a proxy for safe assets and high yield being a proxy for risky assets. And you can see the normal anti-correlation that you can expect between safe assets and risky assets are the blue dots on the screen. They are what we call the normal times. So they are the time when treasury is negative, high yield is positive, or when treasury is positive, high yield is negative. And that has happened about 50% of the time over the last 22 years. The good news for fixed income investors is you also have good times. And those good times are the yellow dots when both treasuries and high yield are positive. And those are performing at the same time. And it actually happened quite a lot over the last 22 years. So that was actually one of the reasons behind the bull market is not only risky assets perform well, but also treasuries. You have, unfortunately, what we call the bad times, when both treasuries and high yields are performing poorly at the same time. But that only happens 7% of the time over the last 22 years. So it's pretty rare that you have this moment when both rates and credit are not working well together. January was one example of red dot, unfortunately, when both rates went up and risky assets did underperform. But we think it's really those times when it's quite transitory because the Fed is changing its stance, taking a more hawkish view, same for the ECB. But over a longer horizon, investment horizon, you go back to the more normal or good time situation. So we don't think it's a time to completely get out of duration. If you want to generate income through credit risk, you will need to keep your duration to balance your portfolio. The second thing we want to talk about is in credit sectors. On the next slide, Sam, please. On credit sector, what is very important is to really look across the board and not necessarily to put all your eggs in the same basket. Over the last 3 years, 2019, 2020, 2021, US high yield was a very strong performer. And over that period, it was very hard to beat US high yield. And I think people who invested in US high yield had a great time. On the other end, you can see EM high yield was more bottom of the range, did underperform US high yield quite a lot. But we think that for investors who are really focusing on income and don't necessarily have a strong view on specific fixed income sectors, it's important to go for a multi-sector approach where you can really combine not just US high yield, but you can go into EM, you can go into securitized assets, because it's very hard to predict what's going to be the next overperformer. And here we see that EM high yield has underperformed a lot. The valuation then are much more attractive than US high yield. It's probably then maybe a time to think about rotating from US high yield to EM high yield, but then you need to understand the fundamental of EM. So the point we want to make is when you build an income portfolio, don't put your eggs in the same basket. Don't try to get all your exposure from one single fixed income sector. You need to diversify. And I'll stop there.
Yeah, thank you, Arnaud, and thank you, Gordon, for both of your overview on the global market. Now let's switch gear to emerging markets, and as what Arnaud was mentioning, emerging markets had a pretty tough year in 2021, and also given the potential divergence between EM and DM post-COVID world. So, Alan, what's your view on the emerging market fixed income for 2022? We heard that Neuberger Berman had a lot of expertise in this area, so very excited to hear your view.
Thank you. We think EMD is going to do well, especially relative to 2021, which was a tough year for emerging market debt. Now, the first reason why we are positive on emerging market debt for this coming year is that we expect emerging market growth to outpace the developed markets growth. There's a few reasons for that. First of all, the global recovery has led to strong global demand, which in turn has led to stronger export volume for many EM countries. So that's one positive. And also remember that many emerging market countries are actually commodities exporters. So as long as the price of oil and other metals are going to stay high, that will be very beneficial for the EM country as well. Hence, there are reasons to believe that EM growth is going to outpace DM growth, and the growth differential may actually go up further as we see that DM countries are tightening their monetary policy, so providing less of a tailwind to support the DM countries. If we could go to the next page, please. Let's talk about entry point. It's actually quite a good entry point. A few of the emerging market countries have actually increased their policy rates last year. So if you're investing in EMD now, it's actually a better entry point because you lock into actually a higher yield. Now, on a relative sense, compared to developed market bond opportunity, let's take US high yield as an example. You'll find that US high yield, despite having a lower average credit rating than EM corporate or EM sovereign, the spread that you can actually enjoy from EM debt is actually quite attractive, especially given its better credit rating than US high yield. So if we go to the next page. Now, I know there are a lot of headline news about emerging market debt recently. One of the topics that you've been seeing a lot is actually on China property sector. Now, the good thing is the market forecast on China growth has been stabilizing. And we also agree with the market that China will perform better going forward. One of the many reasons that we see is that the Chinese government has injected more liquidity into the system via a range of monetary tools, via lending rate, or by reducing reserve ratio for the banks. They have done that in the recent past, and we expect them to do even more in the next few months. There are also signs that the government is going to continue to loosen its monetary policy and to use more fiscal measure to support the economy and the property sector. So things is expected to look better in Q2 or in Q3, for example, for China. And then if you go to the next page. Within the emerging market debt space, in particular, we like short duration emerging market debt. First of all, emerging market debt has a higher yield than developed market bonds of the same rating. So the yield pickup is one of the major reasons. And the fact that it got short duration means that it has low interest rate sensitivity. So the valuation of these bonds are likely to be relatively more stable in a rising rate environment. Now, what's more is that we actually like short duration emerging market debt, the higher quality part, where on average, if their maturity is around 3 years, in that case, we actually have or reserve the option or the optionality we believe is important to hold the bond to maturity. And that's important because many of the time it's actually market noises. If we believe the fundamental and if we believe in our credit research, and if we can hold the bond to maturity, then we can ride out the market volatility and actually enjoy the actual return of the bond. If you go to the next page. This page is just a graphical illustration of why we think short duration EM debt is actually attractive. You can see that it's actually on the upper left-hand corner of the chart, meaning that it got higher yield and also relatively the shortest duration compared to other samples of fixed income alternative here. If you go to the following page, that's also an important point. If you look at emerging market debt, there are many ways to access the emerging market debt economics. You can go local currency, hard currency, the longer duration one, emerging market corporate, or you can go into short duration, high currency emerging market debt, which is what I've been talking about. You can see that because of its short duration nature, the higher quality nature, and also the fact that it's hard currency denominated, meaning most of them are US dollar denominated. In the past market drawdown or the market problematic time, you can see that short duration EMD exhibited a much more robust performance compared to other EM sectors. If you can please go to the next page. Now, last year, as I said, wasn't a good year for emerging market debt, and it wasn't a good year for emerging market corporate. We've seen very high default rate in 2021 for the market as a whole. But we do believe that the default rate is going to go down in the high yield emerging market corporate space in 2022. Now, one thing that I want to highlight is that, as I mentioned earlier, we like, in particular, the higher quality, the average investment grade rated short duration EMD. A lot of the headline news that you've seen in the past is concentrated on the high yield sector, especially the Chinese property sector. The IG, the investment grade space of the short duration market actually performed quite well. There are financial names in India and China and Hong Kong. Their performance has been very stable and been very good, actually. So we will highlight the differentiation there as well. If you can please go to the next page. Yeah, so that just summarizes our view that I mentioned earlier. We think EM growth is going to stay above trend and is going to beat developed market growth. We believe that currently the high currency spread is attractive, and we think low duration is actually the area which is offer a good return relative to its risk. And we think the Chinese property sector is going to stabilize going forward, and actually many of the risk has been priced into the market already, as many actually trading at the distress level. And we think the road ahead will look better for EMD, especially shorter duration emerging market debt. Thank you.
Great, thank you, Alan. And good to know that you are optimistic about the prospect of emerging markets. So now let's get a bit closer to home again and talk about China and Asia. And I think a lot of investors are still a little bit concerned about this market as well, after a lot of headline news and also volatility in the past year, and also continuing a little bit into Q1 as well. So Giselle from Fidelity, you have a very long history investing in this space. We would love to hear your view on this market.
Sure. Thank you so much, Eileen. Despite there has been a lot of market noise and volatility in Asian bond market last year, particularly from the China property sector, we actually still find good value selectively in both Asian and China US dollar bond market. And when we think about to construct our investment views from a bottom-up perspective, we normally assess from three key perspectives, namely fundamentals, valuations, and technicals of these companies. So let's first look into the fundamentals of the slides. Overall, we expect Asia corporate's credit matrix to remain stable on margin, but we do expect there will be some divergence between investment grade bond and high yield bonds. In this slide, you look at the net debt per EBITDA of the companies, which is one of the indicators that assess the financial health of the companies. On the left, you'll find that for Asian investment grade corporates, they're actually pretty resilient despite they faced a COVID outbreak back in 2020. And for this year ahead, we still expect these corporates, the credit profile will remain largely robust with adequate liquidity. On the high yield side, where you see on the right, it seems that they are facing more challenging headwinds with rising debt in 2020. And while seemingly obvious, the fundamentals of some China property names look particularly challenging with higher leverage and refinancing risks. So how about the valuations? In the next slides, we can see that both Asian high yield and China high yield actually offer a relatively attractive yield pickup versus the peers. On the left, in terms of the investment grade spreads across region, arguably Asian investment grade spreads is actually looking pretty tight versus historical average. So this is also one of the reasons why we're pretty mindful on the tighter valuation from the investment grade side. But when compared to its peers like US and Europe in the line in green and orange and yellow, it still offers around 10 to 20 basis points of yield pickup. Asian high yield look more appealing due to the extreme sell-off we have seen in the China high yield property sector last year. If you look into the chart on the right-hand side, you'll find that both Asian high yield and China high yield spreads are actually at a pretty elevated level at the moment. But of course, we have to be very mindful that there could be more default case coming through, and investors have to be very selective to really capture the investment opportunities in this space. And moving on to the technicals on the next slides. So for technicals, it's about demand and supply. And generally speaking, the higher demand, the lower supply of the bonds, the more supportive technical backdrop for the asset class. And on the supply side, you will find that the chart on the left, which illustrates the Asian US dollar new issuance, has been rising over the years with the market growth. But at the same time, if we refer to the net financing of Asian US dollar bonds, we expect that to drop compared to 5-year average on the back of few reasons. One, there will be a pickup in Asia investment grade maturities. And two, we expect there will be kind of more issuers have already pre-financed their issuance given the anticipation of high rates. And finally, there'll be also slower momentum in terms of higher issuance given the weaker market sentiments. But on the demand side, it actually still looks reasonably robust. If we can move on to the previous slides, where you can look at the allocation for the Asian investment grade new issuance. And interestingly, you will find that the allocation from US and Europe investors has actually picking up from 2019, which is also a good indication for more foreign investors, which again anchor the overall kind of demand picture for the asset class. And in terms of our key watch, what I mentioned about fundamentals, valuation, and technicals are the key aspects from credit perspective, but the macro backdrop will be equally important when we think about our risk allocation in the portfolio. So the global growth, central bank policy, and COVID-19 developments are all the critical macro factors for us to closely monitor. I think at the beginning of the session, a lot have been discussing around where the income should sit within the portfolio. And I think the next slide could be a good illustration to share a little bit more how investors can capture the income component in Asian bond market. So in this slide, you see the yield and duration spectrum of how the investment grade and high yield stands across the globe. And let's first focus on the orange dash block. We will find Asian investment grade, like this bold, offer around 2 to 3% yield, higher than the US and Euro IG. And it comes with a lower duration versus US IG. So for investors who are concerned of rising rates environment, investing in Asian investment grade IG could be of advantage, as shorter duration will be less sensitive to the rising rates environment. China investment grades also look pretty appealing with the shortest duration at around 5 years and some more yield pickup. Of course, for investors who can sit through high volatility, Asian high yield and China high yield could offer an attractive income proposition. If we look into the dashboard in the blue side, again, Asian high yield offer around 8 to 9% yield, which is arguably slightly inflated given the market volatility, but income should still stand around 6 to 7% and is still materially higher and more attractive compared to the peers in the US and the Europe. And it comes with a shortest duration at around 3 years. China high yield look a bit extreme here and may not be the best proxy at the moment given the extreme volatility we've seen, but generally speaking, they still offer another 1 to 2% yield pickup versus Asian high yield under normal market condition. Of course, everything looks great, like high income is always good, but there's no free lunch in the market. And so I think we also have to be mindful of the default risk coming through in the next slide. So in the next slide, this slide shows you the default rates across regions. And this also highlights the importance of credit selection, especially if you look into the orange line, which represents the historical default rates of Asian high yield. It's been gradually creeping up, especially with more default cases from China property. So again, it will be very critical for investors to really pick the right credit in order to capture the income from high quality credit names for the longer term investment horizons. And finally, for investors who want to take a balance between the risk and return, the risk-adjusted return may offer another perspective. So in this slide, you will see that there is a 5-year Sharpe ratio across different asset class. So the higher the Sharpe ratio, the better the return investor may capture per unit of credit risk. You'll find that for the Asian bonds, especially the high quality ones in the orange bar, like Asian investment grade, China investment grade, and China onshore bond markets actually stands out from risk-adjusted return perspective versus peers, as well as other asset class like the equity side. So overall, really depends on the investor risk appetite. One could still capture high income or better risk-adjusted into return in Asian bonds from IG and investment grade space. I'll just stop here and pass back to you, Yimi.
Great, Giselle, thank you. So we, when people look at fixed income investing, in a rising rate environment, people get scared and everybody just looks at the Fed and say, oh, they're raising interest rates, we should get out of fixed income. But obviously, Alan and Giselle have highlighted two sectors where, first of all, the rate cycle has been different from the Fed. And also there are still opportunities to pick up yield or reallocate your asset allocation. But, after listening to those two segments on EM and Asia, I thought maybe a step back would be good and hear from Gordon and PIMCO about, global opportunities that may be out there. Gordon?
Sure. Thanks very much, Sam. Let me first just talk a little bit about our philosophy for income investing. So our goal here at PIMCO in income investing is to not necessarily generate the highest possible income for investing in the bond market, but rather to invest in a mix of assets that together produce an attractive level of income compared to what could be achieved from investing in the broad fixed income market. And also to aim to provide a consistent income stream that doesn't vary from month to month. So investors can rely on that predictable income stream regardless of fluctuations in the markets over time. So for this approach and for what is quite an uncertain environment right now, we think it certainly makes sense to have firstly a broad and global opportunity set. So the fixed income opportunity set is well over $100 trillion in size. So there's always places that we can go to find attractive income opportunities. We also think it's important, similarly to how Arno was outlining earlier, important to have diversification across different sectors rather than having a narrow focus just on one particular area of the market that may or may not be in favor at any particular point in time. But on top of that, we also think it's important to have flexibility to be able to adjust exposures and tilt towards the opportunities that are the most attractive and give us the best chance of meeting those income goals, whilst at the same time looking to modestly grow capital over time as well. So it's a diversified approach, but still dynamic in terms of adjusting allocations to different fixed income sectors. So it's a bit different from a traditional benchmark approach, which may have a narrower focus on a particular sector. And it might not always produce the strongest returns compared to individual sectors over shorter periods, but it might tend to have less cyclicality and produce more consistent returns over time. So that's one of our aims. But on to the next page, I would say, even if actually go forward one more, and just to talk about some of the opportunities across the global markets, excuse me, I would say that even if in general certain areas of the fixed income market are arguably trading rich relative to history, and the uncertainty that we've spoken about argues for a more cautious overall approach right now, we're still finding a number of opportunities across different sectors of the market. And again, this is in the context of the income approach I mentioned before, which is to invest in a mix of assets that together provide attractive income relative to the broad fixed income market, and not just necessarily the highest income. So firstly, a sector that we invest in our income strategies that is very high quality from a credit risk point of view is mortgage-backed securities, so agency mortgage-backed securities. So these are bonds that are backed by residential mortgages in the US that come with an effective guarantee from the US government or agencies of the US government. And we invest in these because that guarantee means that they're very safe from a credit perspective. And while they don't provide a very high income, they do tend to provide downside protection to portfolios and diversification in uncertain markets, which means they tend to perform better, for example, than the likes of high yield if markets are doing badly. But they do also provide a bit of extra yield compared to US Treasuries. So on this chart, you can see here that extra yield was around 30 basis points or 0.3% at the end of last year. Certainly not as cheap as they were maybe 18 months or so ago. And generally, we've reduced our exposure here over time, but they can certainly be a good diversifier and provide a bit of attractive extra yield over government bonds. So also looking more interesting in recent weeks as well, as valuations have cheapened up a bit. Then if we go on to, skip the next slide and go to the next one, to talk about, back one, to talk about one of our favorite sectors to invest in right now, and this is non-agency residential mortgage-backed securities. So similar to the agencies that I've just spoken about, these are bonds that are backed by pools of loans in the US, pools of residential loans in the US, but they don't come with that same credit guarantee from the US government. So it does mean that there's some credit risk involved, for instance, if the mortgage holders can't make their mortgage payments. But as a result of this, they do offer a more attractive and a higher yield. And one of the particular areas that we like here is what's known as legacy non-agencies. These are instruments that were issued before the financial crisis around 2005 or so. And what makes them very attractive, we think, is that because they were issued quite a long time ago, the underlying mortgage holders have been paying down their mortgage for the past 15 plus years or so. So their overall mortgage balances have been reducing, making the instrument less risky from an investor perspective. At the same time, or at least for the last 10 years or so, we've seen house prices in the US rising as well. So with both the loan balance going down and the value of the asset backing the loan going up, it means that there's also good downside protection for investors in addition to providing that attractive income stream as well. So I think these are can be an attractive alternative to traditional corporate bonds. And then on the next slide, I would just highlight some broad sectors within corporate credit. So this chart is showing you investment grade corporate spreads, so the extra yield above government bonds for investing in corporates. And we think there's still some opportunity here to add value on a selective basis as well. And that value, we think, is in some of those sectors that have been more impacted by the shutdown of the global economy in 2020 and beyond. So, barring some recent volatility, corporate bonds have largely recovered from that sell-off in 2020, but there has been some dispersion across sectors. So valuations in some of the sectors that are less directly impacted by the shutdown, so some of the non-discretionary sectors like food and beverage, for example, are trading at relatively expensive levels compared to where they were before the sell-off in 2020. And then there's some sectors that clearly more impacted by the situation we're in over the past couple of years, like airlines or hotels, for example. And these have recovered as well, but not quite to the same extent that we've seen in those less cyclical sectors. And valuations in these areas are still, we think, quite attractive, and we think there's still some room for these sectors to continue to perform relatively well going forwards if we continue to see an improvement in the overall economy. Now, of course, there's still the risk of further disruption due to COVID, and so we're being very selective in this area, but it's one that we think provides some potentially attractive opportunities going forwards. And then finally, and very briefly, Also within the corporate bond space, we're continuing to find some value within financials. Many banks, as I'm sure everybody knows, have improved their balance sheets very significantly since the financial crisis. They have much higher levels of capital. A much stricter regulation has also meant that their business models are less risky now than they were certainly before the financial crisis. So overall fundamentals within the sector generally very, very strong. And we think that, for example, certain subordinated bonds issued by banks offer quite an attractive alternative to traditional high-yield corporate bonds. So banks, again, on a relatively selective basis, is another area we continue to find opportunities. And I think that's quite key, actually, with valuations having, or with a lot of spread sectors having performed well over the past couple of years. On the face of it, valuations might not look so attractive when you just look at market beta, but we're still seeing a lot of opportunities, certainly from a bottom-up perspective, to be able to add value.
Great, thanks, Gordon. And I want to give an opportunity for Arnaud as well to touch upon some of the sectors that AllianceBernstein are pretty aggressive, and maybe we can skip the sectors that others have touched and just focus on the Euro high yield, securitized, and ESG that I know you guys are pretty positive on.
Mm-hmm. Yeah, no, for sure, Sam. And I think those are some of the themes that we're implementing across our income strategies. And so they tend to be ideas that we like at the moment, that we are supporting also in terms of relative value. And I'll go quite quickly so that we can take a question, and I will be happy to elaborate a bit further if needed. But Euro high yield is something that we like relatively to US high yield. As I mentioned before, US high yield had 3 very strong years, and so spreads are pretty tight now. Euro high yield has done pretty well as well, but when you look at the yield you get on US high yield versus the yield you get on Euro high yield, hedged back to US dollar, you're not far off. But what's attractive about Euro high yield is the volatility is usually lower than US high yield. And the construct of the Euro high yield universe is actually of better credit quality than the US high yield index. You can see in the chart in the middle that about 2/3 of the Euro high yield index is BB rated, when it's 54% for BBs. And so there is a better credit quality, lower volatility, lower default rate for Euro high yield. And so when spreads are quite tight, you don't want maybe to take as much risk. And so Euro high yield for similar yield in terms of on a hedge basis seems pretty attractive to us. So we've been rotating a fair bit of our US high yield exposure into Euro high yield. The second idea, like Sam, you mentioned, if we skip ahead, is on the securitized front. We like securitized assets, especially those linked to the US housing market. Some of them are called credit risk transfer securities, and they are really a way for us to play the US housing market with a floating rate note component. So in a rising rate environment, it's actually quite attractive due to their floating rate nature, but it's also very attractive due to the very strong fundamental of the US housing market. I think everybody noticed how the price of houses in the US has increased dramatically over the last 3 years. It's been very well supported by demand from the millennials, and it's something that also doesn't scare us too much, because when you look at the mortgage credit availability and the credit and the borrowing standard, they are still pretty tight by historical standard. And so we are not too concerned about a real estate bubble in the US. We feel that people who can borrow have pretty strong credential. And overall, the mortgages are very strongly backed by strong equities in the US housing market. So it's a market we like to play. We also like to play securitized assets like collateralized loan obligation, named CLOs. What you can see that CLOs is for similar rating, let's say a BBB CLO tranche, you get a much higher spread compared to corporate bonds. So for instance, a BBB CLO would pay 350 basis points versus investment grade corporate bonds, BBB at 113 basis points on average. So significant pickup, which can be explained by some of the complexity to understand some of these structure, but we feel like we have the expertise to do so. It's obviously a market that was not benefiting from the Fed buying corporate bonds as well during the COVID crisis. So you do not have the same kind of demand pressure on those securitized assets. And so the yield pickup for us is well justified, and really it means that we're comfortable taking those securitized asset exposure in our income portfolios. So those are the two ideas. And you mentioned the ESG structure. I think this chart on the slide really illustrates well the increasing number of issuance in the ESG space, whether they are green bonds or social bonds or sustainability linked bonds, where some of the bonds coupons are linked to some specific KPI for the issuer to meet. And if they don't meet this KPI, for instance, in terms of carbon footprint reduction, for instance, then the coupon will increase. And so you can see more and more of these ESG structures. Why do I mention those here? Is because from an income perspective and a stability perspective, they are quite attractive. They're slightly more expensive than maybe corporate bonds from similar issuer, the traditional corporate bonds. So there is what we call a greenium. But on the other end, because there is such demand for this type of ESG structures from institutional clients and more from retail clients, you have much less, I would say, volatility, much less sell-off downside on this ESG structure than on traditional bonds. And so people tend to stick with those investments more than maybe their traditional bonds. And so the downside of those bonds is actually, in our opinion, less than traditional bonds. And so we think that by building an allocation to ESG structures in your income portfolio, you bring in even more stability. So those were the few ideas I wanted to mention. And we subscribe to some of the comments that Alan and Giselle made on Asia Credit and EM yield as fairly attractive as well.
Great. And Giselle, I think, touched upon China very briefly in your session about Asian credit, but it is the hottest and most topical subject, and there's a lot of questions about China. So it'd be great if you could maybe touch upon some of the macro backdrop and also, what your thoughts are on China specifically.
Sure. Thank you, Sam. In fact, we actually see selective value emerge from China fixed income, especially the high quality China property and technology names who actually suffer from the negative market sentiments, as well as some of the China policy tightening we've seen over the last year. And as much as we've been talking about the worry from central bank hawkishness today, there is actually an obvious policy divergence between China and the rest of the world. And China fixed income had actually a roller coaster year last year, partly induced by the tightening bias from the China policymakers to prevent the overheating on the credit market. But we could see a turn this year, which could provide some more cushion to the market or even a more supportive market backdrop versus the rest of the world. If you refer to the existing slide on the chart on the left, which is the credit impulse chart, which indicates the percentage of total social financing as per China GDP. There was a big drop in 2021, but it looks to bottom where the drop was decelerating in recent months. And we also see some easing signs on the monitoring side with more rate cuts from China as well. And specifically on the China property, which is clearly the hottest topic across a lot of investors, there is a clearly sector consolidation phase driven by the divergence in cost of funding. And if we look into the chart on the left, you'll find that the cost of funding across the property developers has been quite significant, especially versus the weaker one like the single B and double B, and compared to the investment grade developers in the triple B space. So the high quality property IG developers from our view will be in the sweet spot, especially they will be the key beneficiaries of the sector consolidation as they still got good access to funding supported by their existing business model with good land banks. And of course, looking ahead, we do expect the volatility to persist, especially with the weaker high yield names, with the upcoming maturity wall you can see on the chart on the right hand side. And especially those single B property developers are facing a pretty high maturity wall in the upcoming months and years. So overall, we bias towards high quality issuers who have less concentrated maturity profile, and we continue to assess their fundamentals such as whether they have low gearing ratio, whether they're land banks is high quality enough, and more importantly, their willingness and ability to pay for the offshore investors. I'll pass it back to you, Sam.
Great, thank you, Giselle. And you guys have done such a fantastic job touching on pretty much everything within the fixed income space that we don't actually have too many questions. But there is one top-rated question that I'm going to pose to Alan. The question is, Fed could raise rates for as much as 7 times, and we're still far from it. The market is already panicky. By the 7th time, how bad could the market correct? So before you answer, Alan, I'm going to actually ask the other panelists, what is your house view on Fed interest rate hikes? I think Arnold suggested maybe they're going for 3 or 4, but can you maybe just share what is the house view? What is your own personal view, if you have any, on how many rate hikes Fed is likely to do this year? And just very briefly, Gordon first.
Sure. Obviously, a very topical and very important question.
We won't hold you to it, Gordon.
Our view, particularly after the very recent, very strong labour market data that we've seen, is that we expect the Fed to start hiking rates in March. And we think they're now very, very focused on inflation, which obviously has been very elevated. And as I said before, the print that's due tomorrow potentially could be even higher than the one that we got for the month of December. So this means that we think the Fed's likely to hike in March, and then potentially at consecutive meetings thereafter, so which would be May and June, and then in total around 5 hikes for the year as a whole. So that's broadly in line with what the market is expecting. But their recent communication has been pretty hawkish, and I think if the data does support it, then they may hike more aggressively than this. But also, equally, on the other hand, we would certainly have some sympathy for those that think they might maybe hike soon and then only hike a couple of times and then have to pause for the remainder of the year. So again, there's some uncertainty there, but base case I would say is around 5 hikes this year.
Okay, Arnaud, you're next. How many for you? 3 or 4? Is that where you're sticking to?
Yeah, I think we gradually moved from 3 to 4 recently for this year. I think I just want to highlight, as I said earlier, that with the volatility we can expect, let's say not just in the market, but also from a growth perspective, from potential geopolitical tension and so on. It's important, the Fed, they will be monitoring, they don't set the pace like it's now and say, okay, for the year, we're sure gonna do 5. I think they will be adjusting depending on the conditions, the job market conditions, but also overall growth conditions. And so we agree, first hike in March, probably 25 basis points, maybe another one, maybe in June and September, but we think that by September, some inflation should go down, some growth should go down as well, and so that may lead the Fed just to be a bit more prudent there. So I stick with 3 to 4 for this year, and we'll see. I think the Fed will have plenty of time to reassess as things progress.
Sounds good. We need different opinions here. So Giselle, to make it fun. Giselle.
Yeah, we actually share a pretty similar view. We still expect the hike will be happening in March. But for the upcoming trajectories, it really depending on how the market condition or how it evolves, potentially something around between 3 to 5 times. Because in the US, we think that things can get worse with the Fed doing too late to tempt inflation. But at the same time, how fast and how far the tightening cycle can go, depending a lot of number of factors along the way. Not to mention about how much the real rates the economic and market can digest at the moment. So this is actually something that the team has been continuously discussing and continue adjusting accordingly.
Okay, thanks, Giselle. It's amazing how the markets move so quickly from 1 or 2 hikes in December to all the way to 7 that people are talking about. But obviously, we have a more moderate team. Alan, are you going to surprise us with a different view? Can you wrap it up for us?
Unfortunately not, but I will agree with you that, back maybe 3-4 months ago, the market wasn't expect much in terms of number of interest rate increase, to now people talking about up to 6-7 times. Our house view is more like 4 times. I think I will highlight 2 things. first of all, a lot of the rate hike has been priced in by the market. And second of all, the intention is, or at least the rhetoric is to control inflation. We have to remember that this time round, a large part of the inflation is actually supply side driven. This part of the inflation is difficult to tame by just an increase in policy rate. So there may be uncertainty along the way when the Fed realize that maybe raising rate may not control the inflation as fast, or may not be able to do what they expect. Then there could be uncertainty in the rate hike path.
Wonderful. Thank you so much, Alan. And I think that, we have the experts here, and the experts are telling us that maybe 7 is too much. The market has moved very quickly to a very large number, and that's what markets do. They sometimes overshoot in terms of expectations. And just as the questioner was suggesting, maybe the market will price this in much sooner than we expect. And the reality of a data-dependent Fed plus, inflation with the base effect coming off in the second half, maybe, the experts' consensus of about, I think, range is about 4 to 5 max, maybe potentially, closer to 4 here in this panel, may be right. So we'll watch with eager eyes. And that's why we have these panelists here. I think it's also very important to highlight that fixed income is a space, unlike equities, where active management really does add value over the long term. And we have 4 of the best active managers in fixed income space here with us. So with that, I'm going to wrap up and thank not only my colleague Yulin, but also our panelists today, Giselle from Fidelity, Alan from Neuberger, Arnold from AllianceBernstein, and Gordon from PIMCO for joining us today for this wonderful session. Thank you, guys.
Thank you, Sam.
Thank you very much for having us.
Thank you.
Thank you, and have a wonderful evening. Thank you for joining us tonight.
Thank you.